Good morning, everybody. This is Erik Daly from Miller Johnson. I'm a member in our corporate and mergers and acquisitions group. I'm joined this morning by my partner, Keith Eastland, who is a leader and member in our labor and employment group. And this morning, we are starting the week with a webinar about the newly enacted CARES Act. But before we get into the substance of the program, as we do during our webinars, we like to start with kind of an overview of recent developments in relation to the COVID-19 pandemic and remind ourselves of Miller Johnson's guiding principles through this situation. So over the weekend, there was more sobering news about COVID-19. We saw President Trump announce the extension of the federal government's social distancing guidelines through April 30th. And more locally here in Michigan, COVID-19 cases rose above 5,000 and deaths up above 130 at this point. So Michigan is unfortunately, I think among the top 4 now in the number of confirmed cases in the United States among states. We also saw that on the business side, there is continuing tension mounting between workers, labor, and the C-suite, if you will, in corporate America, with a potential walkout or strike at a Staten Island Amazon facility today looming. Here again, locally, we sadly saw a state legislator, Isaac Robinson, die from suspected coronavirus infection. And then, maybe to end the news portion on a more encouraging note, we saw that General Motors has augmented a Warren, Michigan facility to begin manufacturing surgical masks. And that's in addition to some previous work in an Indiana plant to start manufacturing ventilators under the Defense Production Act. So moving on from that sobering news, at Miller Johnson, we're still committed, and we will remain committed always to working together with clients and the community at large to push through these challenging times and emerge stronger and more resilient. Our Daly guiding principles in this effort are collaboration, loyalty, intellect, candor, and ingenuity. And we're going to apply those principles to the latest major shift in the U.S. legal landscape, which is the enactment of the CARES Act last Friday, which was signed into law by President Trump after being voted on to proceed in the Senate late on Wednesday night and then approved in the House of Representatives on Friday morning, afternoon. Since then, and really since before then, during the drafting stages of the legislation, our firm's been reviewing and discussing this 880-page law across the firm on a truly cross-functional basis and on a holistic basis to help clients make informed decisions and shape their overall strategy in the face of this really unique challenge. This law in particular weaves together financial, tax, employment, benefits, and corporate governance considerations in new ways that we'll discuss this morning. But moving on from those general introductory remarks, why don't we get into the numbers? And the 4 numbers we'll be discussing this morning are $367 billion, and that relates to the first item we will discuss, which is the Paycheck Protection Program, which is to be administered by the Small Business Administration and its approved banks and credit unions, as well as other Small Business Administration loan program expansions and enhancements. We'll then move on, and Keith will talk about some of the enhanced and expanded unemployment benefits that are now in place under the CARES Act. We're talking about these issues in part to provide context and, again, a kind of a cross-functional view on how participation in some of the SBA or other loan or liquidity programs may interact or be impacted by your employees' eligibility for different unemployment or other benefits under the CARES Act. Among those other benefits are $300 billion in the aggregate in direct payments to individuals and families. And then the last number, which we'll go through, is this $500 billion number, which is additional business and government loans, guarantees, and investments beyond the Paycheck Protection Program and the SBA initiatives. So with that, why don't we jump into the Paycheck Protection Program, which I think, based on communications we've had with clients and others over the last several days, seems to be understandably, with a number of small businesses and medium-sized businesses in West Michigan in particular, where we're based, the most potentially compelling of the options. So this is the PPP, which is what we call it for shorthand, is a $349 billion program in small business loans that may be wholly or partially forgiven. In other words, in these loans, quote unquote, if used for particular purposes during a particular time frame and subject to some other conditions, may effectively turn into grants for the small businesses that use them. They are meant to support cash flow to cover payroll costs and keep up with rent, mortgage, and utility payments for the most part. This is a conceptual overview, so we'll get into some of the nitty-gritty momentarily. Again, the loans may be forgiven wholly or partially, and they are generally available to small businesses, which typically would be those with fewer than 500 employees. We'll get into some of the finer points around that in a moment. And that 500 employee number may be higher depending on industry, so we'll touch on that. It's also, the PPP program is also available to self-employed or gig economy workers. And importantly, as we've gotten this question, to 501c3 not-for-profit organizations, as well as certain veterans nonprofit organizations, as long as, again, they have no more than 500 employees. And this PPP program will be available through June 30th of this year. Move to the next slide, please. These are the key provisions. The PPP is a temporary form of a Section 7A SBA loan, but it is very different from your typical Section 7A SBA loan. The size of the loan, the maximum size of the loan, is equal to 250% of an employer's average monthly payroll costs. We'll get into how you calculate that in a moment. Subject to a maximum loan size of $10 million. Importantly, very importantly, to distinguish this program from even some other SBA programs, no personal guarantees or collateral are required of otherwise eligible borrowers under the PPP. There's also no credit elsewhere testing, which means that the SBA does not make an analysis of whether the business applying for a loan is able to obtain financing from another non-SBA or non-SBA guaranteed source. So outside of the SBA program, there's no testing on that front, which there typically would be for most SBA programs. To the extent that the loan is not forgiven, depending on the final terms of any particular loan, you may have up to 10 years of repayment time frame and the maximum 4% interest rate per year, although that could be lower depending on the terms of the loan after you apply for and get processed for a PPP loan. In all cases, there would be no principal, interest, or fee payments for at least the first 6 months, and it could be up to 1 year, again, depending on the loan terms that are set following your application to a qualified bank or credit union that is administering applications for loans. There's no fee to apply. There's no fee or kind of participation, imposed on banks to process the loans or credit unions. So they're very heavily, incentivized to participate in this program. And if you ultimately decided to prepay the loan, there would be no penalty for doing that. And for those businesses that may have already taken out an SBA disaster loan, and we'll talk about these later in more detail, those disaster loans can be refinanced into the PPP program. Let's move to the next slide, please. Okay, so now we'll get into some of the key definitions and address some of, I think, what have been frequently asked questions on our end. The first is, what is a small business to qualify for even participating in the program? And then small businesses are generally those with no more than 500 employees. Employees includes full-time, part-time, and quote-unquote other employees. Other employees does include temp employees and employees that you might get from an employee leasing service. And the SBA guidance says that there are other factors which, similar to determinations of employment under tax law, could lead you to conclude that other individuals are properly classified as employees. Another related question we've gotten, and I don't think we have full guidance on this yet, and so we'll hope that the SBA provides more clarity when it issues guidance in the coming days, is how the 500 employee number is measured and as of what date. The SBA regulations provide measurement dates for different types of SBA loans, but the CARES Act does not provide a date for as of when you would measure the 500 employees for purposes of the PPP. And it also is not clear whether you would apply a principle in the SBA regulations that has the business look back at its average number of employees on payroll over the last year to determine whether you meet that 500 employee threshold. In many contexts for the SBA, you would look back at your average number of employees on payroll over the last year and make a calculation about whether you're 500 employees or not. So, for example, you might be slightly over 500 on the relevant measurement date, but if you had recently ramped up your hiring of employees under that average calculation, you might still qualify because your average number of employees over that period was lower than 500, and the converse might be true. So I think that's probably the right way to think about it for now, but we'll see when the SBA issues guidance. Hopefully we'll get some more clarity on that point, because right now I think that's one of the biggest question marks of uncertainty for potential participants. Setting aside that nuance, important nuance, the employee limit for some industries could be as high as 1,500. So it depends on what your NAICS code is. And so if you have between 500 and 15 employees, don't necessarily, unless you've already evaluated it, jump to the conclusion that you're not eligible. It's worth checking the SBA's NAICS code table to see if you might still qualify, and your bank through which you apply for the loan will obviously help you with that, or we can help you with that, but it's very easily accessible through the SBA's website to take a look at that. The next important concept in determining whether you qualify is the SBA's affiliation rules. Affiliated entities are normally going to be treated as a single employer for purposes of the 500 employee test. Affiliation under the SBA rules is a very broad concept. So it's not just do you own more than 50% of the equity, for example, in another company. There are many tests that are tied to common management or common board members, contractual ties, common financial interests, joint ventures, and the SBA is very clear that even if a single factor may not justify a conclusion of affiliation, that it will look to the totality of the circumstances in light of all the affiliation criteria to determine whether different entities have to be grouped together for affiliation. And in many cases, for example, private equity funds, for example, with a number of portfolio companies are going to have affiliation issues that could be disqualifying because they'll have either control through management or ownership of equity interests such that they'll have to group together the employees of all their portfolio companies when they make that calculation. Some of the exceptions to this, but only in the PPP context, are certain restaurants, food service providers, hotels, and other businesses with multiple locations and that have an NAICS code number that begins with the number 72, and those are accommodation and food service businesses. And in those cases, each eligible location that has no more than 500 employees would be able to apply for a separate PPP loan. And that would be one potential avenue for those businesses to work around the overall $10 million cap and to qualify more aspects of their business as small businesses. Another important exception is SBA registered franchises. And we've had a few clients already that we've identified that they are on the approved registered franchise list. So that is also a very easily accessible document on the SBA website, although we can certainly help you find it or the bank you work with will have it. But it's relatively recently maintained, and it is a complete listing of all the franchises that have SBA registration approval. And then lastly, certain SBIC financed businesses may be eligible for an exception and a relaxation from the affiliation rules. Okay, so let's say you qualify because you're a small business. Now you turn to calculate what is the maximum loan amount that you are eligible for. The maximum loan amount is generally equal to 250% of your average monthly payroll costs, defined term, payroll costs, for the 1 year period prior to the loan date. And again, it's subject to an overall maximum of $10 million on that loan. Payroll costs includes not just wages and compensation, but although it does include those things, salaries, wages, comp, commissions, it also might include cash tips for tip-based employees, vacation, parental, medical, sick leave, certain allowances for dismissal or separation, payments for health benefits, retirement benefits, and then certain state and local taxes. So it's a kind of a fully loaded or fully baked payroll concept when you go to run this. So you're going to want to have as much of that information as possible ready to make that calculation with your bank when you go to apply for the loan, so that you can, make sure you maximize that amount based on information you have to get that 250% multiplier on the average monthly payroll costs. there are some exclusions. So let's go to the next slide. Payroll costs excludes, notwithstanding what we saw on the prior slide, it excludes any compensation paid to an employee to the extent in excess of an annualized salary of $100,000 prorated for the relevant period. But the amount below $100,000 still counts toward payroll cost. So a couple things to break down there. One, the $100,000 threshold does not cover all of the payroll costs that were on the previous slide. It specifically references annualized salary and compensation. It doesn't say anything about the other benefits, taxes, and things like that. So there you're looking really more at just compensation and salary. Secondly, you got to prorate it for whatever period is relevant that you're looking at. So if you're using payroll costs to calculate your maximum loan amount, you're going to be looking back at the last 1 year period to get to an average monthly payroll cost calculation. So there you'd be using a larger number, but for other purposes, you may be using a smaller number, for example, over the course of 8 weeks, which is something we'll get to momentarily, and that's relevant to the forgiveness portion of the loan program. And then amounts below $100,000 will still count toward your payroll cost calculation. So for certain businesses that qualify as small businesses, that have a number of people who make more than $100,000 in annualized salary, you're going to want to identify those people and run your calculations excluding only the amount of annualized salary above the $100,000. So the next exception is, as it relates to the calculation of payroll costs, as a defined term, is amounts paid to persons who reside outside the U.S. So you're only considering your U.S.-based employees for purposes of the payroll cost calculation. You also exclude certain taxes that are withheld during the relevant period. And then lastly, certain payroll costs and for which tax credits are allowed under the last piece of federal legislation adopted on this front, which was the Families First Coronavirus Response Act, or the FFCRA. Let's keep moving, please. Okay. So now, let's say you've qualified because you're a small business, you've run your calculation so you know what your loan amount is, and you've received the proceeds of the loan after applying with your banking relationship. And so now you've got the funds in your bank account, hopefully pretty quickly. What can you use those funds for? PPP loans are generally permitted. These are permitted uses as opposed to forgivable uses. So not all these permitted uses will ultimately be forgivable, but they are permitted to be used for the following items: payroll costs, which we just defined above, same definition applies here. Group health care benefit costs during during paid sick, medical, or family leave, insurance premiums, employee salaries, commissions, or similar comp. And note here that that is in addition to the payroll cost permitted use, which you would think would cover these things already. But our reading of this is that it is meant to expand upon payroll costs because of some of the exclusions that we just talked about that are built into the payroll cost definition. So, for example, non-U.S. employees, there's no restriction on this fourth bullet point here, employee salaries, commissions, or similar comp related to foreign employees or paying salary above $100,000. So those might be permitted uses, but they wouldn't be quote unquote payroll costs. And as we'll see on the next slide, therefore they would not be forgivable. So they would end up ultimately needing to be repaid if you use them for that purpose. The next categories: mortgage interest payments, rent, utilities, and then interest on other existing debt, but not any prepayment of interest and not payment on principal of debt. And the same applies to mortgage, just no prepayments and just interest payments. Let's go to the next slide. Okay, so those are your permitted uses, but if you've taken one of these loans out, what you really want to do is to maximize your forgivable uses of the loan proceeds, because the more forgivable uses you deploy the funds for, obviously the less you ultimately have to pay back, and the more this program works as effectively a grant. So forgivable uses are a subset of the permitted uses. They are forgivable to the extent used during the 8-week period after loan receipt. So you have longer to potentially use the funds for permitted uses, but if you want forgiveness, it's only going to apply to these particular uses during the 8-week period after receipt of the loan. And those permissible forgivable uses are payroll costs, again, excluding the portion of annualized salary above $100,000, but prorated for that 8-week period. Mortgage interest, but not prepayments of interest and not principal. Rent obligations and utility payments. And for those last three buckets, they only relate to mortgages, rent obligations, and utilities that were already in place as of February 15th. So you can incur a new mortgage after that date or a new rental obligation and get forgiveness if you used the loan proceeds for those purposes. So can we go back one slide again? Just want to reemphasize this point because it's one of the main questions. These are permitted uses, but not necessarily forgivable. And then moving ahead to the next slide. These are the forgivable uses to the extent incurred or paid during the 8-week period after loan receipt. Okay, let's keep moving. Okay, so there may be some further adjustments to your loan forgiveness, even if you've used all of your loan proceeds for those forgivable uses during the 8-week period. The amount of forgiveness would be based on the borrower's employee retention and compensation practices. And specifically, there are a couple of tests. One is that forgiveness would be reduced to the extent that the borrower's average number of full-time equivalent employees during that 8-week period after loan receipt decreases compared to the borrower's average number of monthly full-time employee equivalents during one of the following two periods at the borrower's election. The first period would basically be a comparable window of time from 2019, so kind of a year-over-year concept. And then the other period that you could choose would be January 1st, 2020 through February 29th, 2020. So that would be a more recent period, and that's again at the borrower's election. So if you've got a reduced headcount compared to one of those periods, whichever is more favorable to the borrower, you could have a reduction in loan forgiveness, even if you otherwise use all your proceeds for forgivable purposes during the 8-week period. So the incentive here is for small businesses to keep employees on payroll, basically is the policy behind that. Okay, let's go to the next slide. In a similar vein, loan forgiveness would be reduced to the extent that total salary and wage reductions, and again, I will emphasize the words here are salary and wage, not payroll costs. So to the extent payroll cost is a more expansive term. to the extent total salary and wage reductions per employee exceed 25% compared to total salary and wages during the most recent full quarter before the loan is taken out. So similarly, the policy here is, hey, we don't, to the extent that you make significant cuts in employee salary and wages compared to a recent period, your loan forgiveness amount is going to be reduced, even if you otherwise spent all the money on forgivable uses during that 8-week period. Because part of this policy is not just keeping employees on payroll, but also keeping their wages, at relatively comparable levels to recent periods. However, one subpoint here is that reductions in salaries or wages for higher earners, for those with an annualized salary above $100,000, generally are not going to count against this calculation. So the policy underlying that point, I think, is, what they're trying to incentivize is maintaining relatively comparable salary and wages for your lower, your kind of rank and file or medium income earners, but having more latitude to reduce salary and wages for higher earners. Okay, so let's say that you've recently, or sometime within 30 days after the enactment of the CARES Act, had already taken some of these actions. So if between February 15th of this year and April 26th, which is 30 days after the enactment of the CARES Act, if you had already, or you do during that period through April 26th, reduce your full-time employee equivalent positions or reduce compensation during that window of time, you actually have the opportunity to eliminate those reductions by June 30th and effectively reverse those forgiveness discounts that I just described about employee headcount and employee wages. So you have an opportunity to, for lack of a better word, rectify this situation as it relates to your forgiveness. If you bring those people back, it doesn't have to be those same people, but if you get your full-time equivalent employee count back, whether it's the same people or different people, and you get your comp levels back to where they were by June 30th. One kind of open question from our perspective is whether these words that you've eliminated those reductions means that you have to completely get back to the level that you were at previously, both, for FTE positions and compensation, or if it's more of a sliding scale concept so that you might be able to get more forgiveness even if you don't fully get back to the numbers. And I think, or I hope we will see more guidance on that, because the reductions in loan forgiveness that I previously described related to employee headcount and compensation are not an all or nothing proposition. So you're allowed to reduce headcount and you're allowed to reduce salaries and wages for employees, but it may reduce on a pro rata basis your forgiveness. It doesn't exclude you from participating in the program if you take those actions and don't rectify the situation. It just means that you will get less loan forgiveness sort of on a prorated basis. So it's not a binary all forgiveness or no forgiveness. We'll see in the guidance from SBA how they flesh that out for this kind of reinstitution of employees and wage concept by June 30th, 2020. So let's keep going. Some certifications that borrowers will need to make under this program. They'll need to certify that the uncertainty of the current economic conditions makes necessary the loan request to support ongoing operations, and that the funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments. They also need to effectively certify that they're not receiving duplicative benefits. As it relates to that first certification, we note the use of the word uncertainty in terms of potential impact, and we also note that the Act includes a presumption that borrowers have been adversely impacted by COVID-19. And so we think just from the legislative policy perspective and that presumption that's included in the Act that, that first certification is meant to be construed broadly. And we've gotten some questions about, what if my business hasn't felt an immediate impact from the situation? We may see more about this in the guidance, but between the presumption and the use of the word uncertainty, we think this is probably a certification that most businesses, if not all small businesses, are going to be able to make in good faith. So let's keep moving. Some other considerations. I'll try to work through these quickly because we have a lot of other items to get to. As I mentioned a couple of times, we're expecting further administrative guidance to be available in the coming days. Checked earlier this morning and it wasn't up yet, so we'll keep an eye out for it. On the forgiveness front, I think the money will be flowing pretty liberally on the front end for applicants. But on the back end, when you go to seek forgiveness, I think it's going to be more extensive review of the borrower's documentation and support for forgiveness. So borrowers will want to put in place controls and procedures to make sure they can track the use of these funds in a very detailed way. And when you're talking with your bank about this topic, it may be even worth setting up a dedicated bank account to just have these PPP loan proceeds reside in so that you can create a very clear paper trail from that account to the forgivable expenses. This loan forgiveness is not subject to federal taxation, so it's excluded from gross income, unlike many other forgiveness of debt items that could be taxable. This is not. And these PPP loans are not subject to the restrictions that some folks, may have already read or heard about relating to stock buyback restrictions, dividend and executive compensation restrictions. We'll talk about those later at the end of the presentation, which relate to other lending and liquidity programs outside of the purview of the SBA. Let's go to the next slide. So the PPP, as we've mentioned a couple of times, is an SBA program. Logistically, loans will be originated by SBA-approved banks and credit unions and then guaranteed 100% by the SBA. So the important thing here, which I think is critical, is that borrowers contact their banking relationship as soon as possible. I've already seen a number of banks come out and say, we're participating in this, and we actually have started to develop information request lists. So you'll want to reach out to your banks to confirm what they are going to be requiring, assuming that they participate. And I think many will participate, given the government has really greased the skids for their participation in this program through certain terms in the law. So I can't emphasize enough how important it is that you do that, because whatever the law says, you're going to have to work through your bank or credit union to satisfy the requirements that they need to satisfy internally. And so the sooner you know what those are, the better. This may be obvious to some people, but if you already have other loans in place, you want to think about how a PPP loan would fit into your overall capital structure, I guess, and whether there are restrictions on incurring additional debt or signing up to new credit arrangements without defaulting on those obligations. Those are pre-existing obligations. And again, I think to the extent that you can work with the existing lender under any of those obligations in taking out a PPP loan, the more, you're going to be able to facilitate that process. And because a lot of these loan proceeds may be eligible for forgiveness. I would be optimistic that lenders would be flexible in working, with borrowers. Pre-existing lenders would be flexible in working with borrowers to help inject this liquidity because it's unsecured. So if you've got a senior lender, it really shouldn't hurt their position. So let's keep moving. Couple of tax considerations, getting back to the kind of interdisciplinary approach we're taking to looking at this. We wanted to call out two things, and we'll have separate webinars on the tax considerations coming out of the CARES Act. There are many more than this, but there are two specifically that are impacted by participating in the PPP loan program. One is that on this first bullet point, you would not be able to get this refundable employment tax credit for certain businesses that have retained employees despite a negative impact from COVID-19 if the employer receives a PPP loan. Whether or not any of that is forgiven or not, if you've even received the loan, you wouldn't be able to claim that tax credit. So that's something to think about. And then another point is that the CARES Act allows employers to defer deposits of the employer share of Social Security taxes during 2020 and to spread that over 2021 and 2022. If an employer receives a PPP loan, and at least a portion of the loan is forgiven, so any portion is forgiven, then the employer cannot utilize that deferral option. So those are some potential downsides from the tax perspective to participating in PPP, and they may be ones that you're willing to take on in order to participate, but something to think about. Next slide, please. Okay, so that's an overview of the PPP, the Paycheck Protection Program. I want to briefly summarize some of the other SBA programs that are also out there, and some could be used in tandem with a PPP loan. The first most obvious, the most relevant one to talk about is the SBA's Economic Injury Disaster Relief disaster loans, EIDLs. And this program is distinct from PPP. It is not a forgivable type of loan product. The terms of this program have been enhanced and modified through the end of 2020. The maximum loan amount here is $2 million, and interest rates are capped at 3.75%, or if you're a not-for-profit at 2.75%. Repayment terms are longer, potentially, than for a PPP, so 30 years with an initial 4-month payment deferral. And loans can be used for kind of working capital issues resulting from COVID-19. If you have both this loan product and a PPP loan, then you cannot use the EIDL loans for the same purposes that are permitted for a PPP loan. So you have to keep the two sort of distinct and for different categories of expenses. Unlike the PPP loans, the EIDL loans are generally require collateral and from 20% or more equity owners, personal guarantees. That personal guarantee requirement is going to be waived for loans below $200,000, but for anything above that, you're still presumably going to have some kind of collateral requirement and a guarantee, which may make these EIDLs a little trickier to work in if you have pre-existing secured debt or other debt. Let's keep going. These EIDLs are funded directly by Treasury, unlike the PPP loans. So you don't go through a bank or a credit union to get these EIDLs. You go through the SBA's website. And I know anecdotally from people who started, or businesses that started applying for these loans last week, that was not an easy thing to do because the SBA website was overwhelmed and it was difficult to save work. But that's what you presently at least have to do to apply for one of these loans. We touched on this second point already, is that you can use it in addition to a PPP loan, but only for other purposes. There's a temporary expansion through the end of the year of eligible borrowers under the EIDL program, and one of those that I wanted to call out was for employee stock ownership plans, or ESOPs, to the extent that they face liquidity crunches over the course of the year for whatever reasons. If they have relate to fewer than 500 employees, you may be able to use an EIDL to help alleviate some of those liquidity issues. Like with the PPP loans, the credit elsewhere testing has been suspended through the end of the year, so you don't need to show you can't get credit elsewhere. There are relaxed financial information requirements through the end of the year. So the SBA can rely on, for example, just credit scores rather than requiring copies of all kinds of tax returns and additional information, although they may still request some of those things. They can make faster decisions about loans by using credit scores and other criteria that could be promulgated by the SBA. And like with the PPP, there's no cost or fee to apply, not obligated to accept funds if you're approved. Let's go to the next slide. A couple of other SBA loans and resources. If you are applying for one of those disaster relief loans, there is a kind of a sub-program within that called SBA Emergency Grants that would allow a business that is applying for an EIDL to obtain access to up to $10,000 of very speedy capital that would not be required to be repaid. You might get that in as soon as 3 days after applying for an EIDL. And that could be used to maintain payroll, provide sick leave, service debt, or other increased costs. It's available. This is like the other relaxations on some of the EIDL requirements. This is through December 31st, 2020. And you don't have to repay it, even if you ultimately get denied the EIDL. So that's another kind of source of possibly forgiven liquidity, but only up to $10,000. And there's $10 billion allocated overall to support that emergency grant program. And then if there's anybody out there who's already got SBA debt outstanding, the SBA is relieving 6 months of certain principal, interest, and fees for those loans. So it's not a deferral, it's complete relief for certain of those payments. And again, it's tied to employee retention and wage stability. So it's sort of the way that I think about it at a big picture level is if you've already got an SBA loan outstanding, some of that same forgiveness type relief that applies to the PPP loan, the new loan product, you could get that for your existing SBA debt without necessarily having to go change over to a PPP. It's not exactly the same, but there's some relief there as well. Let's go to the next slide. Okay, very quickly, the SBA Express loan limit has been increased from $350,000 to $1 million. And that's kind of like a line of credit through the SBA. And then there's going to be some additional entrepreneurial assistance to help spread information about how certain businesses, minority-owned businesses or women-owned businesses can learn about how to participate and apply, and then also kind of training and general assistance in relation to COVID-19 as well as future potential pandemics readiness. Keep going. Okay, So now I'm going to turn it over to Keith, because as you're thinking about the different SBA loan options, and in particular PPP, I think it's good to understand, at least at a very high level, some of the provisions of the CARES Act that impact your employees. And again, we'll have more detailed webinars on each of these topics later, but I think it's good to have these sort of executive summary type slides so you have it all the major considerations in one place. So I'll turn it over to Keith now.
Thank you, Eric. Thanks to you and your team for putting this together. I know you guys, a bunch of business lawyers, have been scrambling all weekend and working with clients and starting to put these packets together and answering all these questions. And I realize that I'm the tail wagging the dog here, but we did think it was important, at least for this audience, to kind of get an overview of the unemployment provisions in the CARES Act. At 10 o'clock this morning, my partner Marcus Campbell and I will be going through the details. So if you don't get a question answered here, or you want to follow up, certainly do so, or join us at 10. So let me talk about the three key components of the unemployment changes to the CARE Act. And the first, and if you read the law, it's section 2104, and it's called Emergency Increase in Benefits. This is what most of our clients care about. This deals with employees who are normally eligible or are receiving state unemployment benefits. And what the federal legislation under the CARES Act does is it says, look, if you are eligible for state benefits, you will get your state benefit, whatever that amount will be. So that's calculated as it normally would for the unemployment weekly benefit. And then they will add a fixed $600 from federal funds to that. So, and those will be available, those benefits would then be available through July 31st of 2020. So essentially up to 4 months. Now, this additional $600 will not take effect, and it will not be retroactive, and it will not take effect until the U.S. Department of Labor and the state of Michigan execute an agreement for this. And we expect that that'll happen shortly this week, and that the folks will start seeing this extra $600 if they're eligible for unemployment in about 2 to 3 weeks. And so what does that really mean? That means that if you have unemployed workers and you need to lay them off, employees, and they're eligible, the maximum benefit per week in Michigan right now is $362 per week. If an employee were to qualify for that maximum weekly benefit, they're looking at $962 a week. And so that's the big thing. Obviously, there's some significant concerns that some of our clients may have with how do I keep people working if I'm essential business. You know, that's a weekly benefit, and we're going to talk about that at 10 o'clock. But also, if you haven't and you're not aware of it, there's an executive order 2020-24 from Governor Whitmer. That's the most recent pronouncement on expansion of unemployment. There was an early one. This subsumes that. It's an expansion up to 26 weeks. There's some relaxation of the voluntary quitting rule for certain COVID-19 related reasons. And interestingly, in that executive order, there's a relaxation of the actively, looking for work. So if you need to lay your folks off, they don't need to be actively looking for work elsewhere, and they can get the benefits. So this will be a significant increase in employees who are eligible for state unemployment. That's the principal area. The second section of the CARES Act, it's called the Pandemic Unemployment Assistance. That's section 2102. That has to do with creating eligibility for individuals who would not otherwise be employees eligible for state unemployment. So this is an expansion and to these individuals, including self-employed folks, independent contractors, gig workers who couldn't go to the state and get their benefits because they wouldn't be eligible. This makes those class of folks eligible, and for up to 39 weeks total. And the benefit would be calculated similarly to what I explained with respect to employees. And then the third category is extended benefits. Okay, and what this does is if you exhaust your 26 weeks in Michigan, you may be eligible after those 26 weeks for an additional 13 weeks of state benefits plus the additional federal payments. So this is a safety net for folks that aren't back to work after the 26-week period. And so that's the summary of unemployment benefits, the quick summary. And I know you guys have a lot of questions on these loan products, so I'm going to sign off here. But I did just want to answer two questions. One, I get a question about whether these benefits are taxable. Yes, they are taxable to the employee, just like other unemployment benefits are. And the employee has the option to elect to have those taxes taken out before they receive the benefits. And then one other employment question that we've been getting a lot, and I saw it, I think, in the pre-list questions as well as potentially a live question here on the webinar, and it's unrelated to unemployment, but it relates to the Families First Corona Response Act and the paid sick leave and expansion of family medical leave that would be paid under those acts. There was a question about whether or not Governor Whitmer's or the President Trump's order for, shelter in place, the shutdown of the businesses, whether that constituted an isolation or quarantine order that would trigger eligibility for sick leave benefits. Miller Johnson's position was no, that it doesn't, and that has been affirmed by recent Department of Labor guidance. So no, you can't just say I'm affected and I'm on layoff because of, Executive Order 2020-21 because everything's shut down unless it's essential, and therefore I get the sick leave. Nope, that is not a quarantine order. So I did want to clarify that point because I know we've had a lot of questions on that. With that said, I'm going to stop talking, and then I'll stick around to answer any unemployment or employment-related questions, and I'll let Erik run you through the rest of this and get to your questions.
Thank you, Keith. And I know that I've tried to answer a few questions while Keith was talking, and there are a lot, but we'll try to get to as many as possible. Some other of the, and we'll hit on these quickly, we're going to go over an hour for those who can stay, but we did want to cover the PPP for sure during that first hour. Other items in the CARES Act impacting your employees, there's $300 billion for direct payments and deposits to individuals and families. You can read through some of the amounts here per family. So $1,200 per qualifying adult, $500 per child, and there's some means testing to that, so that if you're an individual with more than $75,000 per year in adjusted gross income, that's going to start to phase out, and it'll be totally phased out when you get to 99,000, and then you can effectively double those numbers for persons filing jointly. And the adjusted gross income calculations will be based on your most recent tax filing, although there may be, like, for example, if you haven't filed for 2019 yet, when you get around to doing that, there could be some credit to you coming later as effectively a true up on that, but you wouldn't have to give money back to the government if it changed. Certain student loan payment interests are suspended through September 30th, and there's some limitations on temporary limitations on foreclosure and eviction processes that we don't have time to get into the details of, but these are other things that your employees may be thinking about. Let's go to the next slide. Okay, a couple modifications to retirement plan rules that also may impact the overall calculus here. Some relaxation around rules that will allow distributions of up to $100,000 from certain retirement plans in 2020, and eliminating the 10% additional tax on those distributions. Loans up to $100,000, so not not distributions, but loans up to 100,000 from retirement plans would also be permitted during the 180-day period following the enactment of the CARES Act. And payments due in 2020 under currently outstanding loans, the repayment of those will be delayed until 2021. So just big picture, there's some additional sources of ways employees can access funds through retirement plans. And again, that'll be covered in a separate webinar in much more detail, but just something to bear in mind in the overall mix of borrowing funds or seeking liquidity through other government programs. Let's go to the next slide. Okay, so now we're pivoting back to business-related loans, guarantees, and investments through an entirely different program than the PPP or any SBA product. The Coronavirus Economic Stabilization Act, or called CESA, CESA, allots $500 billion in additional funding for loans, guarantees, and investments for eligible businesses. $46 billion of that is already allocated to certain industries, which we'll go over on the next slide. So there's a remaining $454 billion that will be available to businesses, states, and municipalities outside of those designated industries. And Treasury will be issuing guidance on these programs for this $454 billion, or really for the full $500 billion, sometime within the next week-ish. Let's go to the next slide. So these are the amounts that have already been tagged for certain industries. They're the ones you've probably read about or heard about. $25 billion for commercial airlines, ticket agents, and aircraft maintenance or inspection services. $4 billion for cargo air carriers, and $17 billion for businesses that are quote unquote critical to maintaining national security. Next slide. So other potential uses of these funds, the remaining $454 billion will be available through December 31st, 2020 for loans, guarantees, and investments to support eligible businesses, states, and municipalities. Again, important to emphasize, unlike PPP loans, these ones will not be subject to forgiveness. So for businesses, CESA eligibility will be limited to those businesses that are organized or created under laws in the U.S., which have significant operations in the United States, and for which a majority of its employees are based in the United States. Generally available to companies whose continued operations might otherwise be jeopardized. Next slide. Mid-sized businesses specifically, this would be of more interest to this audience. The CESA portion of the CARES Act states that Treasury and the Federal Reserve should create a program to provide special assistance to U.S.-based mid-sized businesses and not-for-profits that have between 500 and 10,000 employees. So these would be businesses that are too large for SBA participation. So we'll see what this looks like. We don't have really much in the way of detail beyond what's here, but there should be some kind of program targeted at mid-sized businesses that get sized out of SBA loans. The interest rates for those mid-sized business loans would be capped at 2%. There would be a maximum 5-year term for repayment and no interest or principal payments during the first 6 months following loan origination. Treasury otherwise has very broad latitude as to the forms, terms, and conditions for these loans and investments, and they are available to originate until the end of 2020. Next slide. Certifications that businesses participating in the CESA program would need to make are more expansive than the certifications that PPP participants would need to make. see the list here. There's a similar item first on the list about the uncertainty of the economic environment. That is essentially the same as the SBA loan certification. But others which go beyond that are that the borrower would retain at least 90% of its workforce at full compensation and benefits through September 30th, that they intend to restore at least 90% of the workforce that existed as of February 1st, and to similarly restore any reduced comp and benefits that have already been reduced. They must certify that they will not outsource or offshore jobs until 2 years after the loan has been repaid in full. And then on the union front, they need to commit that they will not abrogate existing collective bargaining agreements until 2 years after the loan has been repaid in full, and that they will remain neutral in any union organizing effort for the term of the loan. So much more extensive certifications for these loan programs. Next slide. We kind of touched on this in the certifications already, but the recipients of these CESA funds must, to the extent practicable, maintain existing employment levels measured as of March 24th through September 30th, 2020. And in any case, they may not reduce employment levels by more than 10% during that period. Treasury, when they make these loans or investments, needs to receive either equity interest, warrants, or senior debt instruments. So it's a different product than the unsecured, unguaranteed loan that you're talking about in the SBA product. This is a more substantive product. There's a prohibition on common stock dividends until 1 year after the loan has been fully repaid. Go to the next slide. There's also a prohibition on stock buybacks until 1 year after the loan has been fully repaid, although I'll note that this only applies under the statutory language to equity securities listed on a national securities exchange. So for mid-sized businesses that are not publicly traded, this stock buyback restriction may not actually apply, presuming that your securities are not on a national securities exchange. And there's also an exception for pre-existing stock buyback commitments that predated the enactment of the CARES Act. And then lastly, for certain of these loans, there would be executive compensation and severance pay limitations for officers and employees with total compensation in excess of $425,000 in 2019, and some additional restrictions that would only apply to officers and employees with an excess of $3 million in total compensation. So that's something you would obviously, all these restrictions are things you want to more fully understand before, signing up to a loan under the CESA program as opposed to the SBA programs. Let's go to the next slide. The administration of CESA funds will be done by Treasury and subject to oversight by newly created Special Inspector General's Office and a Congressional Oversight Commission of 5 individuals that will be appointed by the majority and minority leaders in each of the House and the Senate, and then a jointly designated 5th chairperson for that Oversight Commission. So there will be audit and investigative authority. The Inspector General will be appointed by the President with subject to the advice and consent of the Senate, so similar to a cabinet type posting. The point here is that there's going to be some level of public scrutiny associated with participating in this program that will be more intense than, being a participant in an SBA program where there's no similar mechanisms of oversight and congressional reporting and the like. And then lastly here, CESA funds may not be made available to any business in which senior federal government official or their immediate family members holds more than a 20% interest. So that's president, the vice president, heads of executive departments, and members of Congress, I believe, plus their immediate family members wouldn't be able to participate in these programs. All right, I think that made a couple of additional considerations, which are important here, and we just don't have a lot of detail on yet. One, the first one here, the Federal Reserve may establish a supplemental Main Street lending program, is what it's called in the Act. It doesn't mandate that this happen, but it says that the Fed may establish this program or a similar facility that would support further lending. So in addition to the SBA lending, further lending to small and medium-sized businesses. So we'll see where that goes. And then to the extent that Treasury does end up obtaining common stock through any of its CESA lending or liquidity programs, it would not exercise voting power as a shareholder. Next. Okay, so that's it. There's a lot to digest, and we went 8 minutes over on the presentation itself. Keith and I are listed here as contacts, but know that we have quite a few people who are up to speed on the SBA lending programs in particular, and then Keith and his team and our tax teams and benefits teams are all up to speed on those aspects of the CARES Act. So I'll take a little time here to scroll through questions and try to answer some. I'm certainly not going to be able to get to all of them because it looks like there are 100 questions queued up right now. And by all means, if these are still questions later, or if you talk to your banker and you still have questions, feel free to contact Miller Johnson about these, and we can address some more of them. I don't know, Keith, maybe while I've been talking, are there any other questions in your area that you want to address while I kind of scroll through some of these?
Yeah, well, I was just going to say, while you were talking, I had an opportunity to answer some of them in writing, and so I've answered some of those questions. But rather than spend time on the unemployment questions, I think you've got the majority of them, and maybe 90-some% are all relating to the loans. And so what I think might make sense is we will take the questions related to the unemployment ones. We'll tack those on to our 10 o'clock webinar, and then we'll address those, we'll add those questions as additional ones to that one, and we'll try to get, published responses to all the different questions from the unemployment side. And my guess is some of them will be overlapping, and so we'll just handle it that way, Eric, if that makes more sense, because my guess is the folks on the line want to get the loan questions answered.
Sure.
So. Okay.
I'll just bear with me. I'm going to do some of this on the fly. So one question was in relation to private equity funds. Does this mean, so the affiliation issues, does this mean that private equity firms are not eligible? It means that many private equity firms will not be eligible just because through the totality of their connections with their portfolio companies, they will end up exceeding the 500 employee limit or other higher limit depending on the industry. So it's going to depend on how many portfolio companies, how many employees are employed by the portfolio companies, what industries the portfolio companies are in, and what affiliation factors would tie the fund together to its portfolio companies. I think as a broad matter, many PE firms are going to test out of this, but not all. Okay. Can you apply for a PPP loan for wages paid to essential employees while other employees are on temporary layoff? Restaurant with takeout services? Yes. Yes, you can. Whether you're essential, so the distinction between essential and non-essential employees is a background consideration here, but it is not a concept that's a state level concept in any particular state. It's not an issue that's addressed directly by the PPP or the CARES Act. Similar question here. As the private equity one, how do I determine if minority VC ownership might trigger affiliated entity issues? This could be its own very extensive webinar. Again, it's going to be based on, hopefully we'll get some guidance on it, first of all, because I know the private equity and venture capital groups have been, lobbying to get some additional relief throughout this and more clarity, but it's going to be a totality of the circumstances test to determine whether certain companies need to be grouped together that, venture capitalists have ownership interest in. So there's no easy answer there, unfortunately, and those ones are all going to be more fact-intensive inquiries. I think, again, I just answer it similarly to the private equity answer, that many larger VCs are probably going to end up exceeding the 500 or other threshold, but not necessarily. So you have to kind of look at the details.
Erik, one of the questions that we've gotten, and when you read some of the summaries of this online or other places, is if you take one of these loans, is there some sort of union neutrality provision that attaches? And when, if ever, would that apply?
Right. So that does not apply to the SBA loans, including the PPP. That only applies to that second program that I discussed, the CESA. So generally for mid-sized businesses and larger. So if you're a small business and you're just going through the Paycheck Protection Program or another SBA product, you don't have to make those union neutrality certifications. That would just be the second program that I discussed, the CESA. Does that make sense, Keith?
Yep. I just want to make sure that people understood that. So if you're applying for that type of loan, you have to worry or consider that. But those union neutrality provisions don't apply to the PPP and other programs. It's just that one section. So that's good. Thanks, Erik.
You're welcome. So another question was, it's a computation of the annualized payroll costs for the 12 months immediately prior to applying for the loan, or is it permitted to use 2019 calendar year? It's going to be it's going to be the 12 months immediately prior to the loan application, not the 2019 calendar year. You can't just go back and use 2019. Unfortunately, that would probably be easier, but the answer to that is no. Do insurance costs cover all insurance or just healthcare related? So that's a good question for a distinction between permitted uses and forgivable uses. The permitted uses generally references insurance costs, which I would read as, property and casualty insurance, for example, or workers' comp insurance. But for the forgivable uses, it's going to be more limited than that. I think it's really just, on my reading, going to relate to the healthcare costs. So you may be able to use the funds for other insurance, but if you want to maximize your forgiveness, you would use the funds for things that are employee related, in the sense that they're, tied to health and benefit programs, for example. Are bonuses included in the average payroll cost? Do you net out employee contributions for medical benefits? Bonuses is not specifically referenced to my recollection, so we'll see if there's guidance on that. If it's a bonus to somebody who ends up getting in excess of 100,000 in salary because of the bonus, I'm not sure how that would impact them, whether you'd have to exclude that bonus amount above 100,000. That's a good question, and I think something that, probably requires either further guidance or taking a position where there's some ambiguity under the statute. And I'm not sure about netting out employee contributions for medical benefits. I have to take a closer read at the statute for that one. Okay, if a company does not want to immediately apply for a PPP loan, what is the latest date loan applications can be submitted? It's a good question, and I'm going to answer it more broadly than the question asks for. I'll answer the direct question first. June 30th, 2020 is the latest date you can apply for a loan under the PPP. But, just kind of back of the envelope math, would suggest that, there's the amount of $349 billion for all these PPP loans is probably not going to cover the demand for them. So there's some risk, I think, in waiting until later. There's also some strategic consideration around when you start to trigger that 8-month period. And that may be partly what this question is getting at, because to maximize your forgiveness, you want to have the forgivable expenses be incurred during that 8-week period after the loan is originated. And so there's been some speculation about, does it make sense to wait so that that 8-week period can be, at an optimal time to maximize forgiveness. And I think that's a valid question, but it has to be weighed against the notion that you want to get in as early as possible for an application and then go from there. So, but June 30th is the last date you can apply, and whether there are still funds available, I think, is a separate question. Does credit card debt that is used for our small business count as serviceable debt that may be forgiven? It's not specifically addressed by the statute, so possibly. At least, and in any case, it would be the interest on that debt. If any of it were allowable as an expense, it would just be the interest and not the principal, and you couldn't prepay interest. So only the interest that's already due. But honestly, I don't know whether they would view credit card debt as debt that could be a permitted expense. I would think probably, but we haven't looked into that issue yet, and it's not addressed specifically by the statute. I think we addressed this one partly in the presentation, but it's a recurring question. Are payments to employees earning $100,000 or more annually permitted use, including the amount of $100,000 annually? I think our reading is that it's a permitted use, but it's not a forgivable use to the extent above $100,000 in salary. So we'll see if the guidance takes a different position, because I will say there's some ambiguity. It's not crystal clear in the act that that's the case, but I think that's the better reading, that you could use the loan proceeds for amounts above 100,000, but that portion of it above 100,000 in salary would not be forgivable. Would not be forgivable use. So you'd have to, that part of it would convert to the 4% interest loan. What utility payments are included? Phone, internet, electric, and gas. All of those are included, I believe. That is defined in the statute. I don't have it right in front of me, but my recollection is that, yes, all of those utilities are included, and that is the bulk of them. but there might be one or two others that are specifically listed in the statute. Would rent include lease of semi-tractors? Not sure. I have to go look at the statute on that one. Good question. Maybe try to address some of the more generally applicable ones here, given we'll try to stop at 9:30 here, so we don't go more than half an hour over. Do payroll costs include retirement benefit contributions on behalf of your employees? I believe they would include at least the employer matching contributions, whether amounts directed from your employees into a retirement benefit plan. I'm not sure about. To go back and look at the payroll cost definition to parse that one out. But certainly amounts that the employer is contributing to benefit plans would be considered payroll costs. The question here, do you choose an 8-week period between February 15th and June 30th? That's a good question. The answer under the statutes would be no. Well, yes, in the sense that you can choose kind of when to apply for the loan and get it originated, but that the statutory language says that the 8-week period runs from when the loan is originated. However, I did see a summary of the Paycheck Protection Program from Senator Rubio's or from the Small Business Committee in the Senate that suggested that borrowers could choose an 8-week period. That's not the way the law is written, but I don't know if that may be some foreshadowing of further guidance that we get. So maybe it'll be possible to apply for the loan, get approved, and then choose when you actually take it on. But the 2 or 3 page summary that I saw circulated from the Senate group said that it did specifically reference choosing an 8-week period. So we'll see when the further guidance comes out. But until then, we're operating on the assumption that the statutory language, which is 8 weeks from the time that the loan is incurred or originated. I am an LLC and take a monthly draw. Do I assume that the draw amount isn't calculated into the 250%? That's correct. That would not be considered payroll cost, and it would not be a permitted use in my reading of the statute as well. If we have eliminated overtime for the foreseeable future, does the OT need to be reinstated by June 30th to avoid the forgiveness reduction? You would look at, so I hate as an attorney giving it depends answers, but I think it depends on, how much overtime we're talking about, how much of a percentage of the employee's wage and salary, relates to overtime work. So possibly, but it just kind of depends on how that ties into the 25% number for the reduction threshold. Nothing in the Act specifically addresses overtime, so I think you would just need to do your best to factor it into the wages and compensation measurements that are included. So no clear answer on that. Maybe something we'll get guidance on, but maybe not. We got a few minutes left here, and I apologize in advance. It looks like there's still 122 questions lined up here. Is there a list of banks somewhere participating? The SBA website probably has a list of currently approved SBA lenders, but I think the list will be more expansive by the time all is said and done here. And I think you can assume that many banks and credit unions will be participating lenders in this program. I don't have a list handy, but I think probably the SBA website would have a list along these lines. Here's another question. If we were able to cover the cost of payroll, insurance, utilities, and rent, presumably before applying for a loan, will there be a way to get refunded for this after COVID-19 is done, or is it only if we apply for the loan? This forgivable loan item is not retroactive, so it doesn't apply to past amounts incurred. It's only, again, for the forgiveness only applies to the permitted expenses during that 8-week period after the loan is incurred. So no, barring some other legislation or stimulus or something like that that's passed, there would not be payments for similar past amounts incurred. Can you apply and accept both an EIDL and PPP loan? Yes, but you have to use them for different purposes. So anything that's a permitted use under the PPP, you would need to use EIDL loans for something different. So you can take both on, but it's to me, again, just more of an administrative hassle, I guess, but it may be worth it to go through to make sure that you're using funds from each program for acceptable purposes. There's a question, is there more detail about the 50% payroll credit? Yes, there is more detail, not in this presentation, but there will be client alerts and webinars from us about that in the coming days and how you qualify for that. But unfortunately, we don't have one of our tax colleagues to provide that detail. We just wanted to call out that if you participate in PPP, it could impact your ability to get that credit. Okay, we'll take one more of these, and I again apologize that we're not going to get to all of them. Some of these are questions we've already answered. If I have given my employees paid time off for this shelter-in-place order starting on March 24th, is any of that eligible forgiveness? Yeah, this is another version of a question I think we've answered. The forgiveness is really just the 8 weeks after you incur the loan. So things you've done already can't get forgiveness for. There may be some things that you can reverse in order to maximize your forgivability of expenses incurred during that 8-week period, but not apply retroactively to expenses you've already incurred before the loan is originated. Okay, so it's 9:30, and I know you could probably stay here all day and answer questions. If you do have questions, you can certainly feel free to follow up with on the PPP items. Folks in our firm who are especially attuned to these issues are me, My partners, Dustin Daniels, Max Barnes, David Hall, Loic Demeef. So on the PPP questions, you can reach out to any of us if you work with any of us, whoever you want, and we'll get you connected. And then on the employment and labor issues, tune into Keith's webinar at 10. And again, I would just encourage folks who are thinking about participating in these programs to also talk to their banking relationships, because I think a lot of this is going to be, administrative type things and information requests the banks can handle either in tandem with or even apart from attorneys. So thank you for joining, and we'll look forward to staying in touch through future webinars, and I hope you have a good day. Take care.